You're sitting in a brand new car, the smell of new leather, a bright touchscreen glowing in front of you. The door closes with that satisfying, powerful thunk. You imagine driving into work tomorrow morning, parking right at the front, coworkers glancing through the glass, friends texting you, "New car? That's awesome." Your hands rest on the steering wheel, your heart beating a little faster with pride. But there is one sound you don't hear. Not the engine, not the bass from the speakers, but the quiet sound of $750 leaving your bank account every month. The sound of 7% interest moving silently toward you. The sound of 72 months of commitment to the bank, longer than many relationships. The car accelerates from 0 to 60 miles per hour in a few seconds, but its value drops 20% the moment you leave the parking lot. You think you're driving a symbol of success, but in reality, you just signed a contract for 6 years of financial pressure. The real question isn't, can you afford that car? The real question is, how many investment opportunities, financial freedom, and peaceful nights of sleep will that car take away from your future? Today, we're going to talk about the sweetest trap in consumer culture, the brand new car, and the real price you actually pay. My name is Sophia. With many years of experience working in banking, reading extensively about finance, and researching car loans, today I want to help you understand the financial traps that come with owning a car through financing. Traps that many of you may have experienced, are experiencing, or may experience in the future. Once you understand these traps, you can avoid them in a much simpler, calmer, and more relaxed way. The reality of car payments in America. Before we talk about how this system works, let's look at the real numbers. The average new car payment in the United States has crossed a level that people would have considered crazy just 10 years ago. We are talking about monthly payments that are higher than many people's rent. Yet somehow, millions of Americans continue signing contracts every month, driving off dealership lots in cars that cost more than the median household income. Here's the interesting part. Most of those people are not secret millionaires. They didn't inherit huge fortunes. They aren't crypto billionaires or children of wealthy families. They are workers, teachers, nurses, mechanics, retail employees, office workers, ordinary people with ordinary jobs. Yet somehow the numbers are made to look reasonable, or at least they try to convince themselves they are. The truth is that there is an entire system designed to make impossible payments look possible. A system designed to convince you that, don't worry, you can totally afford it. But those decisions can quietly derail your financial future for 7 to 10 years. So let's start with the most obvious question. How big are these numbers really? Because when I tell people the average car payment, they think I'm exaggerating. The average new car payment is now over $700 per month. $700. Not luxury cars, not supercars, just the average price for a normal new car bought by a normal person. But it gets worse. Pickup trucks and SUVs, now the default choice for many Americans, often come with payments over $900 per month. And it's not unusual to see payments over $1,200 per month. $1,200 every month. For 6, 7, sometimes even 8 years. People think they're paying just a few $100s a month. But over the life of the loan, the total payment can exceed $60,000 or even $80,000 for a completely normal car. And that doesn't even include insurance, fuel, or maintenance. You might think, Sophia, people must be making more money now. Salaries must have increased enough to support this. But I hate to deliver bad news, they haven't. Median income has increased, yes, but nowhere near enough to justify these payments by traditional financial wisdom. Trap number 1, extending the loan to lower the monthly payment. When people see a $1,000 monthly payment, the first thing they think is, how can I lower this payment? and the bank immediately offers a solution. Lisa is considering buying a $40,000 car with a 7% loan over 5 years. Her monthly payment would be $792. That feels expensive. So the bank offers another option. Extend the loan to 8 years, and the monthly payment drops to $546. It sounds like the bank is helping Lisa, but in reality, the bank is simply moving more money from Lisa's pocket into the bank's pocket. If Lisa chooses the 5 year loan, the bank earns about $7,520 in interest. But if she signs the 8 year loan, the bank earns about $12,416 in interest, nearly double the interest. And it gets worse. You'll still be paying for the car long after its value has dropped dramatically. Cars depreciate quickly, especially in the first few years. By year 5 or 6 of an 8 year loan, you often owe more than the car is worth. This is called negative equity. You can't sell or trade the car unless you bring cash to cover the difference between the loan and the car's value. Now, trap number 2, the 0% interest advertisement. You've probably seen the huge signs at dealerships. 0% APR financing. It acts like a magnet pulling you into the showroom. It sounds like free money, but there is something the dealership doesn't want you to understand. 0% is not free. The cost of that 0% is usually built into the price of the car. For example, you may be offered two choices: pay $37,000 cash or finance at 0% for 4 years for $40,000. The interest has already been included in the higher price. More importantly, the approval requirements are extremely strict. You usually need a credit score of 720 to 760 or higher. Ironically, the people who qualify for 0% financing are often the same people who could have paid cash anyway. Also, the cars included in these promotions are usually older models or vehicles that dealerships want to clear out before the new model arrives. The goal is simple: get you into the showroom. Once you're inside, it becomes much harder to leave without buying a car. Trap number 3, trading in your old car. Then comes the famous trade in game. Lisa bought her car with a 7 year loan. After 3 or 4 years, the car starts to feel old. It doesn't have the newest features. It doesn't look as nice as the new models. She wants to upgrade. But the value of her car is now lower than the remaining loan balance. The dealership tells her, "Don't worry, we'll take care of everything." They roll her negative equity into a new loan for an even more expensive car. Now Lisa is paying for a car she no longer owns while also paying for a new one. Her debt keeps growing even though she's been making payments for years. Dealerships love this cycle. It creates lifetime customers. Once someone is trapped in negative equity, leaving the cycle requires paying thousands of dollars upfront to close the loan. Trap number 4. Upgrading to premium trim cars come in multiple versions. Base mid-level premium salespeople often say, maybe you should add softer leather seats, 64-color ambient lighting, a bigger screen, a panoramic sunroof so you can see the same sky you saw yesterday. They don't say, this adds $8,000. They say, it's only $95 more per month. And that's when everything begins. A base model costs $40,000. The premium version costs $48,000. That's an $8,000 difference. But with a 72-month loan at 7%, you're not just paying $8,000. You pay additional interest, higher insurance, higher taxes, and you lose the investment opportunity for that money. The ambient lights don't make you richer. 20-inch wheels don't grow your bank account. Massage seats don't pay your loan. Yet every month, you keep sending money to the bank, all for features you barely use. The most dangerous part? Those features make you believe you deserve them, but in reality, you're just paying for the feeling of status. 5 years later, the car loses half its value. But the extra money you paid, that's gone forever. Try trap number 5, rearranging your life to afford the car. Lisa knows that $700 to $1,000 per month is too much. It empties her emergency fund and investment account. But she reassures herself, it's okay. Once I finish paying it off, I'll have a great car. And this is when things become creative. And creative can mean long-term disaster. People restructure their entire financial life around their car payment. Some move to a smaller apartment, some delay moving out, some eat cheap meals daily, all to support a car payment that takes 20 to 30% of their after-tax income. Some even get a second job, driving rideshare or delivering food, using the expensive car to earn money to pay for the expensive car. The car becomes both the boss and the tool. Even worse, some people take personal loans or home equity loans to cover negative equity. They are literally using their house to support their car habit. But houses build wealth. Cars lose value. That decision reverses the entire wealth building process. Trap number 6, multiple car loans in one household. A quiet suburban morning, 2 brand new cars in the driveway, an SUV for the family, a sedan for commuting. From the outside, it looks like the family is moving up. But let's do the math. SUV, $720 per month. Sedan, $650 per month. Total car payments, $1,370 per month. With insurance, fuel, and maintenance, it can easily reach $1,800 to $2,000 per month. Many households earn $8,000 to $10,000 per month before tax. After tax, maybe $6,000 to $7,000. Nearly 30% of their income is sitting in the driveway. The problem isn't owning one car. The problem is owning 2 financed cars at the same time. If someone loses their job, credit card interest rises, the house needs repairs, kids start college, the car payments don't disappear. Banks only care about the due date. And here's the real trap. Cars depreciate faster than you pay down the loan. After 3 years, cars may lose 40 to 50% of their value, but you still owe most of the loan. Selling the car may require paying extra cash to close the loan. From the outside, the family looks stable, but financially, they are locked into 2 depreciating assets. Trap number 7, the real cost of owning the car. Lisa thinks she bought a $40,000 car, but that's not the real cost. Let's break down the true yearly cost. Depreciation, about $3,600 to $4,000 per year. Fuel, $1,600 to $1,800 per year. Insurance, $1,800 to $2,500 per year. Maintenance, $800 to $1,200 per year. Parking, registration, tolls, etc. $800 to $1,500. Total operating costs, about $9,800 per year. Add the loan payments, the real cost becomes about $19,300 per year, nearly $1,600 per month. Lisa thought she bought a $40,000 car, but over 5 years, the car can cost $95,000 to $100,000. And after 5 years, she still owns a car worth only $20,000. That's the biggest trap. You don't buy a car with the sticker price. You buy it with your future cash flow. And many Americans are driving a $1,600 monthly expense without realizing it. Final thoughts. The car is not the villain. The problem is not the car you drive. The problem is whether the car is driving your finances. Financing a car isn't wrong. 0% financing isn't wrong. Premium trims aren't wrong. The mistake happens when you only ask, "How much is the monthly payment?" instead of asking, "What is the total cost? Do I have an emergency fund? If I lose income for 3 months, can I survive? Does this car move me closer to financial freedom or further away?" A few gentle suggestions. Keep car payments under 10 to 15% of income. Prefer shorter loans. Sparker, consider 2 to 3-year-old cars. Don't upgrade just because it's only $80 more per month. Always build an emergency fund first. A new car brings happiness for a few months. Financial peace brings good sleep for many years. In the end, you don't need to drive the most impressive car on the street. You just need to drive the car that doesn't stress you out when the payment is due. Because true wealth is not what's parked in front of your house. It's the freedom inside your bank account. My name is Sophia. These are lessons from my own journey. If I missed something, please leave a comment so we can all learn together. If this video helped you, please like and subscribe to support the channel.